Both traders and investors are just buying stocks from the same market, like shoppers at Walmart on Black Friday. One grabs and runs, the other reads the label for 3 hours. But in the end, they both just want one thing: to make money. Trading is short-term. You buy something because it's going up. You sell it before it starts going down. And if you're wrong, you pretend it was a learning experience. Investing is long-term. You buy something because it's valuable. You hold it, endure 5 recessions, a pandemic, 3 elections, and 1 existential crisis. Then you sell it at a quiet profit if you haven't forgotten your login. So, what is trading and investing? Trading. Goal: profit from short-term price movements, hours, days, weeks, or months. Approach: buy low, sell high, or vice versa in short selling, based on market timing. Examples: day trading, swing trading, scalping. Focus: price action, technical charts, news events, and volatility. Investing. Goal: build wealth over the long term by buying and holding assets. Approach: buy and hold fundamentally strong assets and wait for long-term growth, years or decades. Examples: buying shares of Apple or index funds and holding for 10+ years. Focus: company fundamentals, macroeconomic trends, financial statements, and valuation. Time horizon. Trading. Duration short-term, minutes to weeks. Objective: quick gains. Investing. Duration long-term, years to decades. Objective: wealth accumulation. Traders live in minutes, investors live in decades. One's chasing opportunity, the other's married to patience. Guess which one sleeps better? Mindset and strategy. Traders. Psychology. High stress, fast decisions, and no emotions. Just cold, robotic execution. Crying is for aftermarket hours. Strategy. Heavily uses technical analysis, momentum indicators, candlestick patterns. Mindset. How can I squeeze money out of today's volatility before lunch? Investors. Psychology. Patient, emotionally resilient, long-term thinking. Strategy. Fundamental analysis. That is, analyzes PE ratios, growth, and company moat. Reads earnings reports like bedtime stories. Mindset. Is this business solid enough to hold for 10+ years? Tools and analysis used. Traders. Main tools. Technical indicators. Price charts. Key focus, entry-exit points. Short-term trend. News sensitivity extremely high. Traders often use tools like RSI, MACD, Bollinger Bands, Fibonacci retracement. Sounds like wizardry because it kinda is. Investors. Main tools. Financial statements, news, trends. Key focus business model. Earnings, value. News sensitivity. Moderate to low. Unless it's fraud or the CEO joins a cult, they don't flinch. Investors care about the balance sheet, income statement, CEO leadership, and competitive advantage. Income potential and effort. Trading. Basically a part-time job. You blink, you miss the exit. You pee, you miss the entry. Skill curve. Steep and unforgiving. Investing. Buy once, maybe check quarterly. Dividends roll in while you're watching Netflix. Skill curve. Gradual and forgiving. Example scenarios. Trader. Spots a breakout in Nvidia stock on earnings day. Buys 100 shares at $120 and sells at $126 in 3 days. Profit, $600, excluding fees. Success equals timing, reflexes, and a strong bladder. There's no bathroom breaks when candles are moving. Investor. Buys 100 shares of Nvidia at $120 and holds for 5 years. Thanks to AI. Price grows to $500 due to AI boom. Profit. $38,000 plus possible dividends. Success depends on patience and compounding. So, which is better? Neither is better universally. It depends on your goals, time, skills, and personality. You should trade if you enjoy fast decisions and market psychology. You can lose money before lunch and still eat calmly without flipping your desk. You can handle frequent losses and stay rational. You should invest if you want steady, long-term growth. You like the idea of passive income and your blood pressure staying under 200. You can be patient and think in decades.